Good day, fellow investors. We analyzed Adidas 3 months ago, and since then the stock didn't do really well. And the main thesis back then was that only we Eastern European Balkan boys wear Adidas, and my wife also said that it's getting famous and trendy in Pakistan, which means that over the long term it will go down, as there will be some sales, yes, but this is not what the world wants. And consequently, since then, the stock has been down 30 something%. So this is the message I get often in life, and it's time you get it too. But there have been some huge developments. Of course, this was some Sunday morning, so really casual, but I have caught my wife wearing three stripes too. So that is something that might indicate that the stock might be a good one, no matter the brand, but just the cash flows, because there are still sales. And if we check at the long-term trend of the business, let's say we can take a trend there and see, okay, this was exuberance because of, I don't know, hot and everything, but now it might be oversold, and we have to check that whether it is a good buy or not. Similarly to Adidas, it's not just Adidas that went down, Nike is also down significantly. So all these shoe companies were pretty exuberant at that time, and now those are down. So we have to check how are the valuations there and how will those valuations be in the future. Don't get confused by this P ratio of 11 because margins are going down, which means that this P ratio will likely be 20 soon down the road as earnings go lower. But let's analyze the business, the sector, discuss a bit the business again as it is 30% lower, discuss what other analysts estimate, make a valuation, and then conclude with the investment thesis that I have already told you it looks good, and now you have to see what we discuss and then see how it fits you. That's the key of investing. If you like this investment analysis, please smash that like button, 3 stripes. Now, the first slide of the presentation, investor presentation, and then give me this. This is insane. How in the hell do they think that we Eastern Europeans are going to buy these things? So this is the reason why the stock is going down. This is something we don't even need to discuss anymore. Then I look at the agenda for the business presentation and I see this. What the heck is this? If these are shoes and people buy them, I don't know who should I worry more about, the people that buy this or the company Adidas. I know I did a video that says I'm not going to short stocks, and then I discussed a Tooth Shaft, Oatly, okay, should have shorted them, but I said I won't. But these shoes really tell me, okay, maybe Adidas is the stock to short the heck out of it. Nevertheless, in their earnings call, complaints, justifications, war, inflations, consumer spending, China, supply chain challenges, whatever is the culprit for things not going as planned with them, but that's normal with people. Aren't they seeing this? They think the factors are external. Nevertheless, back to business. If we look at the key takeaways from the last earnings call, they still are growing in Western markets, but I expect that to turn into a negative as the situation with retail and with everything is developing. So more of the business is growing, but driven by product innovation. Oh boy, that's going to hit you harder than you can imagine. Top line momentum, okay, they say yes, revenue growth and everything, but you will see later in the financials, Adidas is not a growth stock. And then they will go after long-term opportunities. Okay, good strategy. And then they show me this. They show me this, which is Balenciaga. What is Balenciaga? Is this some potato? But then I researched, and it is the same designer that designs the IKEA Fracta bag. So they are going after those IKEA Fracta style, let's say, trend brand influencer, which is again something that tells me that there is really a brand issue with Adidas. But okay, they have, as we have seen, brand issues, Balenciaga, and we have to now check, okay, despite the brand issues, what's the value from a terrible brand, terrible this, terrible that. What's the value from that investing perspective? Can it go worse from here? Or am I buying the cash flows that here and there you have to buy Sunday mornings or something like that? And is that enough to make this a good investment? If we look at the strengths and weaknesses, this will turn into a weakness. This we'll see. This might likely be the positive there long term, as Asia Pacific is just growing. E-commerce is irrelevant due to all the returns and the profit margins there. And product innovation, that's certainly a negative. And we have macro, sales declines in Greater China, margin recovery. This we'll discuss a little bit more in detail because it's very important. Why would they recover margin? Because it's not that easy. And then with all other costs going into, the margins are smaller, the profits are smaller. For now, everything is still great, revenues are up, but let's look at the next quarterly and then again 2022, the fourth quarter, how it will end for them, because people in Europe have much less money to spend now. So that is something. And gross margin is down significantly and will be even lower, as we will see now in the projections. Okay, they were hit in Greater China, good in North America. That should slow down, and this should all slow down. So even if China goes up, this should bring it to equal. And they expect, and this is huge, they expect lower gross margins, 1.7 percentage points. That is huge for what a business like a shoe business is, where every little 1 percentage points is extremely important. And then they expect the second half of the year to have even lower gross margins, so even lower profits. If they did 300 million in the first quarter, they will do 100 maybe in the second part of the year. And let me just show you the net profit margin. Let's say it was 7 with just a decline of 1.6, and then last year also 1.7. That's 3 percentage points declines. And then the new net margin is 4. And that's why you see this PE ratio of 11. And as profits decline from 7 to 4, the profits will halve and the PE ratio will be back to 20, where it was historically. That is the impact of the margins, and that's also a reason why the stock is down. Profits go down and the stock consequently follows. This PE ratio shows the past, this PE ratio shows the future. And now, if we look at their outlook by market, they have mostly downgraded it themselves. Okay, something in Latin America, but will that be enough to justify what's going on? I doubt it. And then again, gross margins, usually those are 52, 54 for these shoe businesses, and now we are looking at 49, which means that net income will decline significantly. And I think that, okay, 1.3 billion, but not counting Q4 and Q3 as a whole year. So next year it might even be 0.5 or let's say less than 1 billion, because this still had the good first quarter, first part of the year. And now let's see what analysts estimate and then compare it with the market's reality. If I look at Nike and okay, also down, and some people say that you better run for the hills. Of course, that is now the sentiment in the sector, but if you look at Seeking Alpha, and if you want a 60% discount to the premium version here, then you can click in the link in the description below. And if I look at all the analysis, everyone is extremely bullish. Of course, this was a strong buy. Now it's 50% lower since April, but it's always good to get to information here. And I looked at the articles here, but it summarizes the following. If we go to earnings and earnings estimates, you can see here that the current earnings are 4 per share, then to 3 per share. This is likely for the ADR here adjusted, so just reference. And then everybody expects that the earnings will come back to current 2021 levels again. So just 1 year of temporary. If this happens, then the stock is extremely cheap. Plus, the long-term expectations are for revenue to constantly grow and to almost double over the next 7-8 years, which is something extremely exuberant. I have never seen such growth. And if this is reality, then the stock is an absolute bargain. But a little bit more about these mentions later. Let's now value the company and see at which level it fits you. So I have looked a little bit at net income over time, and there are periods when it is strong, like it was in the years here, but there have also been often periods, okay, this was the pandemic, but there were also periods when those profits weren't as high. And these were extreme profit margins for the whole sector. And the key question here, what if things return to normal for the next 5 years? If things return to 1.3 billion, how does that impact the company? Of course, they plan to return a lot of money to shareholders, but they will not be able to return 6 billion to shareholders if they make 1.5 billion per year. This will be at the lower end and perhaps even lower. And given what's going on in the environment, I think this will be even lower. So at best, we can say 1.5 billion per year. But let's be real and say 1 billion per year in valuation. And if we just look at the balance sheet, it is good, very low debt. So I can say 1.5, 1 billion per year, depending on how conservative you want to be. There is no growth. Because if I look at the financials here, and this is again the nice 10-year financials that we always loved. So revenue growth has been ridiculously low. Okay, they sold some things and that capital allocation and shit like that. But this is no growth. This is a no growth company. And the gross profits are also not stellar. So operating income, again, here a little bit 2017, 2018, we have seen some positivities. 2019, now we are already significantly down, returning to the means of the past. So there will be likely bad years again, and that's something you have to expect as an investor and then see how it fits you. If I take 1.5 billion and compare it to the market capitalization of 20 billion, okay, that is a 7-8% return from now, which is still good, but it can also become a 15% return. That's why I say, okay, Adidas is a good stock now, offering 5, 6, 7, 8%, and that will likely be the certainty there. So it is no growth. We have seen in the past bad capital allocation, design issues, and my wife's remarks are the key issues there. Never bet against my wife, as we have seen here from 3 months ago.
I told you so.
But it is value, but it's sluggish value. So you have to see how this fits you. There is no spark, there will be no turnaround, there will be 1 to 1.5 billion, and everyone else is after them. The last shoes I bought were not Adidas, were this. Those are great shoes, and next time I'll buy again these ones. And this is then Deckers, and this perfectly shows how sluggish these businesses can be for a long time, and then boom on something, crash, and then and then we are back down. There might be some dividends, etc. So it is a highly competitive environment, but I think Adidas will do okay because of the scale and everything. But the question is now, what do you want to invest in? Do you want to invest in will do okay, which means you're unlikely to lose money over the long term. It can go lower, then you simply buy a little bit more, and you will get that dividend, you will get that likely slowly growth over time. That's about it. There is no miracle, there is no quality, there is no, like Charlie Munger says, buy great businesses at fair prices. This is a fair business at a good price. And there is a huge difference between the two. So see how this fair business at a good price fits you. Of course, when it looks good, when the business will look good again, and in the next 5 to 10 years, I'm sure there will be a year or two when they change a Balenciaga designer. There will be years that these things look good, then you sell it. As goes the Wall Street joke, a person with a horse comes to the veterinarian and asks, "Can you help me? My horse behaves 3 days badly, 3 days he does great. Do you have a solution?" And the veterinarian says, "Of course I have a solution. What is it? What is it? What do we have to do?" "Well, on the 3 days that it behaves greatly, sell it. Perfect example for Adidas. So the sales are there, the brand is there, should be value, and then even in the worst case scenario, should be value to someone ballsy enough to buy this. The issue is that most owners are institutional investors, so they don't really care. They care about their fees, not about your pension. We have there a big issue. Stockholders, global, again, no importance of effect there, but this is very interesting from Adidas annual report, and we'll discuss that more in a video tomorrow. Look at the target. So the stock price was here around 300, now we are at half of that, and 63% of analysts recommended that investors buy their share. We are now 50% lower. Can you imagine that on Wall Street? So that's something. And now we have to ask ourselves, what will make it go higher when it comes to investing? Well, we have a China rebound and economic stability in the developed world, and everybody liking the three stripes again. That's what has to happen for it to go higher. What will make the sucker go lower? Competition, margins, inflation, costs, and Balenciaga designers. So see how it fits you. For me, it is a pass because no matter at what price it goes, I'm looking for that great businesses at a great or fair price, or one-way bets where I can't lose much, but I can make significant amounts of returns if I hit the right moment in time. So if I park my money in Adidas, I might do 7, 8, 9, 10% over the years depending on the market, but I would then miss on something that is better. So to conclude, Adidas, I think in a diversified portfolio of 30 stocks where you simply invest in something, what's cheap, buy more of it, reinvest the dividends, and simply manage it, let's say with half an hour a month, then it might really fit you and it will lead you to okay returns over time. That's it. See how it fits you. Thanks for watching, and I'll see you in the next video.